Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. We are back for the start of the week and we're excited for this one. We're going to be revisiting a format that was proven successful the last time we did it. But my name is Bryce and as always I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Excited, as you said, to bring this format back. It worked last time. Hopefully we can make it work again. But we're going to be doing a long form interview across all of the 4 episodes this week. We're going to be talking to one expert and really going deep on what he's seeing in the markets. We'll still be doing Watchlist Wednesday, so don't worry about that. But yeah, we loved it last time, so hopefully we love it again this time.
It is our absolute pleasure to welcome to the studio Roger Montgomery. Roger, welcome.
Great to be with you guys.
Roger is the founder and CIO of Roger. I'll start that again. Roger is the founder and CIO of Montgomery Investment Management, and as Alex said, we're going to be digging into how you're thinking about the markets today, as well as some of the stocks on your watch list, Roger.
Sure.
So let's start at the top. What are you seeing in markets at the moment? What's your general feel? It's a bit frothy.
Look, it's been expensive for a while, actually, and the fact is that stimulus, unconventional monetary policy has been the cause of that. And so in normal circumstances, and I've been investing now for over 30 years, I would have said the market was going to crash quite a long time ago. But those old rules are thrown out the window because of this massive quantitative stimulus that we've got from central banks. The markets always find a shadow to jump at. There's always something to be worried about and always something to be scared of. You've always got someone in Australia saying the property market's going to fall 30%. By the way, it never will. Happy to talk to you about that. Happy to talk to you about that later on. And today, the big thing that everyone's worried about is whether central banks are behind the curve in terms of raising rates because of inflation. So we've had reassurances from central bankers, including Jerome Powell at the Federal Reserve and Philip Lowe here at the RBA. They've all said that you won't need to worry about inflation. I've had Guy Debelle personally tell me I don't have to worry about inflation, and I can expand on that in a minute. But the market is concerned, the market's worried about it. Now the great thing about it is that pretty much 9 out of 10 times, what the market is worried about, it didn't need to be worried about. And I suspect this is going to be one of those things where we should be relying on the central bankers' reassurances rather than trying to second guess them.
Well, let's unpack that a little bit because you're right, inflation, it's the buzzword of the start of 2021.
Sure.
There was a lot of fear and now recently we've seen data out of the US that is showing inflation in the system. But you're telling us not to be worried. So,
well, central bankers are telling me not to be worried, and I'm just conveying that to you. Don't shoot the messenger.
So, why are they telling you not to be worried? I guess.
Sure. Well, let's take a step back. So, inflation is a concern for investors because what it does is it causes central banks to need, because it has a detrimental effect on the quality of living or the standard of living. It's the big bogeyman in terms of reducing our standard of living and through our purchasing power being eroded. Central banks typically slow economies down to stop that inflation from occurring or to quell that those inflationary forces. And so if inflation is jumping or going up, and if it's going to be persistent, then central banks would need to raise rates, short-term rates. That'll have impacts across the spectrum of the economy. It'll be beneficial for savers, for example, through the migration of people feeling that deposits are more attractive than having their money in risky assets. Yeah. That transmission mechanism, through that transmission mechanism, it means investors sell stocks, they sell other stuff, and they put their money in term deposits, for example, because they become more attractive. We're a long way from term deposits being attractive.
Yeah.
So I'm not worried about that transmission mechanism yet. Then at the long end of the curve, the bond market anticipates that rates are going to rise in the future, and so they try and set the rate ahead of time in the bond market. Consequently, the yield curve steepens. When the yield curve steepens, that's particularly bad for the really pointy end of growth stocks. So companies that have their earnings in the distant future, they're not earning anything today. There's a promise or a hope that they'll earn a lot of money in 20 years' time or 15 years' time or 10 years' time, but they're not profitable today. They get hit the hardest in a yield curve steepening environment. And that's just through the present value formula. So if we increase rates, for a given increase in rates, a dollar earned in a year's time, the present value of that future 1 year dollar only changes marginally. But the present value of a dollar earned in 10 or 15 or 20 years' time, that changes a lot for a given change in interest rates. And so those companies, their intrinsic value is hit the hardest. And that's why you've seen, Afterpay's off 50%. Tesla's off from 800 to 500. That's natural when the yield curve is steepening and when long bond rates are going up. And that's what we've seen. So US Treasuries have gone from 0.5 just over a year ago, 14 months ago. They're up to 1.6, and they've been as high as 1.74. The former president of the New York Federal Reserve has been out recently in the press saying he thinks the 10-year bond rate will go to 4.5%.
Whoa.
Wow.
Now, if he was right, if he was absolutely right about that, then that would potentially be a disaster for growth stocks. We're not so concerned about that, but having said that, we are positioning our all-cap funds with some defensive growth in there, as well as turnarounds, or if you like, those companies that are leveraged to a reopening of the economies as a result of COVID ending, that COVID crisis, and that'll take some time. And we've also still got some growth stocks, and that's what we want. But the big concern is that if the Fed decides to stick by its plan to wait until inflation is persistent or wait until wage growth is persistent, then the market will be concerned they're behind the curve.
Yeah.
And so that's what the market's worried about. I don't think we have to worry about that.
Yeah.
I actually think it'll be temporary. And I think it'll be temporary for two reasons. Reason number one is the base effect. So pretty straightforward. You've got really low rates of inflation or deflation last year. And then when you compare inflation this year, or prices this year, to that low base number, it looks like a big change in inflation. So you mentioned in your introduction that we're seeing very strong rates of inflation. I think annualised about 4.2% at the moment, which is much higher than I think the highest we've seen in 40 years. So everyone's really concerned about that. But Jerome Powell said that base effect, if you fast forward in 12 months, then you're going to get a high rate compared to a not so high rate, and you'll see disinflation again. And then the other reason why Jerome Powell thinks that it's going to be temporary is that the big increases across the commodity spectrum that we've seen, everything from lumber and steel to copper and agricultural and softs, all of those commodities, that is a function of us emerging out of lockdown, obviously, and the supply chain not being able to catch up.
Yeah.
Right, but that'll be fixed as well. You think about it, if lumber's increased 275% since February last year, and you're a timber mill, you are going to pump as much lumber out of that timber mill as you possibly can, right?
Yeah.
And if there's not enough trucks, you'll go and buy trucks
Yeah.
to make sure there's enough trucks. You want to get that stuff out there as quickly as you can. So capitalism solves that problem, and you get a supply response to elevated commodity prices, which then quells those prices. That takes a bit longer than a year, but it'll still happen. And so I think this will be a spike. During that spike, what does well? Commodities do well, real estate does well, value stocks do well. But then when we swing back to disinflation, which I think we will, then the growth stocks that have been sold off, they'll be the things to buy again. So I think there's a good news story here. And longer term, structurally, I think we're in for much, much lower rates of inflation, because you might remember in 2017, 18 and 19, you had people like Bill Gates talking about a universal wage. And why was he talking about a universal wage? Because spending on technology meant that automation had basically displaced a whole bunch of jobs. Truck drivers will be out of jobs because of autonomous trucks. People who used to manufacture cars and weld together the frames of cars, it's all robotic now, right? And so that hasn't gone away. In fact, spending on that over the last 12 months has accelerated. So we've seen the fastest rate of increase on spending on IT, software and technology than we've ever seen in history, just in the last 12 months. While we're all talking about COVID, people are out there putting money into automation. And so when we've got the luxury of not talking about COVID anymore, we'll be talking about jobs being displaced by technology, and that's a deflation or disinflationary influence. Wages will be kept lower, and if wages are low, and Guy Debelle told me this probably 18 months ago, had lunch with the National Australia Bank, and they invited Guy Debelle. There was only about 11 of us in the room, and he said, look, unless we've got wages of 2 to 3%, wages growing at 2 to 3%, we're not going to get inflation of 2 to 3%. So, I see long-term structurally lower inflation.
There you go. Well,
Sorry, that was a bit of a mouthful.
No, that was
good.
Great.
Yeah.
That was great. That was a very clear explanation of this whole situation. We have a economist that hosts one of our other podcasts, Comedian The Economist, and he said this inflation looks like a reopening story and it's temporary as well. So glad we're hearing from him and from you similar things. I've got to ask though, if you think inflation is going to be temporary,
Yes.
And growth stocks are being sold off massively, are you buying the dip?
We're always buying. We're net buyers. So, we're always interested in good quality businesses when they appear cheap. There are plenty that still aren't cheap enough.
Yeah.
The Teslas of the world aren't cheap enough, and, even Afterpay arguably is not cheap enough. But there are always things to buy. I suspect that this story hasn't played out yet completely. And so while we're interested in some stocks, we don't think the story's played out. So we'd rather buy them at our estimates of value or below our estimates of value rather than a slight premium.
Yeah.
Because I don't think there's a great rush right now. Yeah.
Another part of the market, I guess, that is attracting a lot of investors in our community is crypto.
Yes.
What are your thoughts on Bitcoin and what's happening there?
So I'm not a cryptocurrency expert, but I've done a lot of reading, and I have a 20-year-old son who has been rather successful in trading cryptocurrencies with an algorithm he and a mate have built in Python. And they're just trading, by the way, they're just trading popularity. They're momentum trading this stuff. Yeah. So I have sympathy for both views. I firstly do not believe that Bitcoin is going to be a universal currency that replaces fiat money. I can see a bunch of reasons why that will not happen. Fundamentally, sovereignty, nation sovereignty will just prevent that from occurring. It doesn't matter how much people power there is, sovereignty will prevent that from occurring. But I've also got sympathy for this idea that there's merit in some of the projects on some of the blockchains. So for example, non-fungible tokens on the Ethereum blockchain. They are a fascinating bit of technology. When you and I transact a house, we transfer title to that house, and that title contains the lot number and the folio number, and that's about it. And the size, it's got some dimensions and stuff on it, and that's probably it. And for the surveyors, an NFT version of that, a digital version of that, would have all of that information, but it would also have who bought it and who sold it and at what price and at what date. If there was any modifications to the property while it was owned by a particular owner, that could be logged into that particular NFT, that non-fungible token or that digital stake, proof of stake. If you think about art transfers with a certificate of authenticity. It says this is a genuine Van Gogh. That's it. That's all it says. But again, it could have where it was stored, the temperature it was stored at, who framed it, who bought it, who sold it, what price was paid. There's so much more valuable information that could be developed and added to that digital proof of stake, that becomes almost as valuable as the asset itself. And without that proof of stake, that asset's not as valuable. And so I can see that as being incredibly disruptive. Businesses like Computershare, Dead Man Walking, PEXA, which is the old New South Wales Land Titles Office, Dead Man Walking. So if there are currencies that these projects trade in. For example, that's the ether. So then there's merit in the idea of owning those sorts of currencies if you believe that these projects are going to have legs beyond that little world that is digital art at the moment. And so I've got sympathy for the bearish view that it's a bubble and there's no way. Well, look, it probably is. There probably is an aspect of bubble behaviour to it. I don't think that's going to lead to, by the way, an economic collapse. If that bubble bursts, because those assets aren't held on the balance sheets of systemically important financial institutions, you're not going to have a financial crisis if those things collapse. So there is a lot of behaviour that, in my experience, looks like a bubble, and if it all crashes, a lot of the people who really don't know what they're doing, they will disappear. They will vacate the market, but that doesn't mean it'll go away permanently because of there's merit in some of these projects on the blockchain. I think the blockchain is an incredibly good idea, and it might be just a little bit early at the moment, but it's going to be something that we're going to be talking about for decades to come.
Fascinating.
Yeah.
Well, that is all we have time for today's episode. An absolute pleasure to have you with us, Roger, and looking forward to carrying out the rest of this interview over the next 3 days.
Yeah, I'm glad we've got 3 more days because there's plenty more to unpack and we've got the time to do it. So join us tomorrow for more with Roger.
Equity Mates, from our mates at Spaceship. Investing made easy.